Okay, good evening, everybody. I hope you are all fine and you had a good day. I think we are only two people on the class so far. I don't know what the rest are up to. Maybe they will be joining us. And if they're not able to join us, then I'll send them a recording of this class so they can listen in at their free time. So maybe just an overview. I hope Jessica and Sarah, you can all hear me clearly. Sarah and Jessica, if you could just confirm if you're hearing me, and then you can again mute your microphones.
Victor, I can hear you very well,
Okay,
very
okay,
clearly, and I can see everything.
okay, good. That's fine. Jessica, could you just confirm if you're getting me well? Okay, so advanced accounting is just like the name suggests, it's an add-on to the accounting that you have already looked at. Initially in our financial accounting, and maybe those of you could have done financial reporting, we mainly focus on knowing how to prepare financial statements, or how do we come up with bookkeeping and recording of financial transactions. And then we also look at how do we use this information, how do we interpret this information, and then you also look at how you actually compile these financial statements. Now, at an advanced level, or the level which we might call specializing, we go more into a detail, and you will realize that some of the topics that we are going to be covering under advanced accounting are going to be more specific to particular kinds of operation or even different kinds of industries, but it is all going to be building onto the previous financial accounting. The basic concepts of double entry are going to remain the same. Now we're just going to enhance and make a little more entity specific or operation specific kind of reporting and accounting. Uh, our first topic is going to be partnership accounting. Partnerships, you all know that different kinds of entities that we have, when you maybe take a look back on your business law, in terms of having entities, we can have a limited liability company, or these are the most common ones that we all know and which most of us work with. We also have body corporates, which are under an arrangement of a partnership. A partnership, basically, you have, it is a legal entity, but with a partnership kind of arrangement whereby you have three partners coming together, and the partnership can be limited liability or it can be unlimited liability. We have entities like trusts, and we even have companies that are limited by guarantee. Some of them can have share capital, others might not have a share capital. Now, accounting for trusts, then limited liability companies are more or less the same, and that is mainly what we dealt with under financial accounting. And in this module, we shall look at how we account for partnerships, because the basic things of bought goods, sold goods, received cash, made payments to creditors, those are going to remain the same the way we looked at them in financial accounting. But there are operations or there are transactions specifically that are going to be tailor-made or can only be found in a partnership kind of arrangement, and we shall look at these in particular. For example, when the partners come together, they are all going to have capital accounts, because if I am partner A and we have partner B and we have partner C, they are all going to bring in money into the organization. We can have where B is leaving the partnership and remain with A and B. How are we going to account for that? We can have 3 partners, but only 2 partners are fully participating in running the company and we are paying them salaries. How are we going to treat those salaries? They are 3 partners in total, but only 2 partners are actually participating in the day-to-day running of the business. So we have to get a way of accounting for salary that we pay to these 2 partners. Partners can give money to the partnership and maybe they charge the partnership interest. We have to get a way of accounting for it. When they make profits at the end of the year, they are going to have to share these profits. How are we going to distribute these profits to the different partners? So under partnership accounting, we are going to be looking more into that detail. Then we will also take a look at accounting for joint ventures. That is going to be our topic number 2. Joint ventures are limited liability entities, but that are working together. We can have maybe Total and Toyota working together on a particular project. How are we going to account for that? And you will notice that there's just going to be a slight change, especially when it comes to sharing of expenses and sharing of any returns that are going to accrue to the entity at the end of the accounting period. Then we're going to look at bills of exchange and promissory notes. This is more of a payment mode, and you will find that it's a little bit more of like a financing option that might be available to companies. Then we'll take a look at accounting for loyalties. Um, uh, there could be there are particular operations whereby you're going to have your asset and you're going to be paid loyalty or rental because somebody else is going to be using your asset. How are we going to incorporate this in financial statements? It's more like rental accounting, and you will see how that is dealt with. Then we have consignment accounts. Consignment is basically where we have like agency. Somebody is holding items on behalf of another person. How are we going to have this incorporated in the financial statements? Then we have hire purchase transactions. I think this is common. I think even in some of the modules like entrepreneurship, you must have come across it. Hire purchase is basically where you buy something and you do not pay for it in full. It could be a car and you buy and you're going to be paying in installments. Maybe you can pay for it over a year and you're paying an installment amount as the year progresses, maybe on a monthly basis, on a quarterly basis. How are we going to incorporate that in the financial statements? Not forgetting that if you're going to be buying on a hire purchase, the cash price cannot be the same as a hire purchase price. If you're going to buy a Toyota Land Cruiser maybe at 150 million, and that is the cash price. If you're going to buy it at a higher purchase arrangement, it could be like 170 million, and you find you're having an additional 20 million incorporated in to cater for the financing aspect, because you are going to be paying in our installments. So how is that accounted for in these financial statements? Then we have branch accounting. I think I don't know if any of you has interacted with an entity that actually has a branch. Um, Most of the companies that you are familiar with are going to be subsidiaries. If you take a look at entities like Stanbic Bank, MTN Uganda, the popular companies, they are going to be subsidiaries. But we have companies that are incorporated, maybe like in the USA, in South Africa, and when they come to Uganda, they do not incorporate new companies, but they just register as branches. Okay, so the birth of the company legally is somewhere else in a different country. That is where the incorporation has taken place. But when they come to a country like Uganda where they want to put another operation, they do not register a new company. They just register a name and they register it as a branch. So in effect, when you go into the legal part of how this company has come into existence, there is no birth of a company here locally, but we just have registration of a foreign company locally, and it is being registered as a branch. So such entities are going to be accounted for separately. If you have a company incorporated in Kenya or in the USA and it has a branch in Uganda, ideally that is one company but with operations in different countries. So there is going to be how you're going to treat the transactions between the head office and the branch that could be in a different country. So that kind of accounting also has to be looked at. And we're going to look at public accounts. This is mainly accounting for public sector, that is government. There are specific things that you have to consider when you're looking at public accounts. So we will look at those specific um, aspects that relate to public accounts. Then we have accounting for insurance companies. Insurance companies, they're also companies like others, just that there are things that are a bit particular to the insurance sector. So we will take a look at them. Insurance being more of a specialized industry, there is even a full standard that talks about accounting for insurance, and that is IFRS 17. It is going to be effective in January 2021. So it talks about the different aspects that are really specific when you're dealing with accounting for insurance companies. You realize that insurance companies have aspects that you're not going to meet in the accounting that you have, for example, studied. In insurance, we have terms that are a bit special, things like you have to account for an event or you have to account for a situation uh, um, of making a provision for losses that might have been incurred by an insurance company, but they haven't been reported. Say, let me put it this way. Assuming I'm Jubilee Insurance Company and I'm preparing my financial statements for their ending 30th of June 2020. Okay. So 30th of June 2020 is my last date of my financial year. And I'm closing my books. I'm reconciling the banks, I'm posting all the revenues, I'm reconciling the cash. Basically, I'm doing everything. I'm tying through my financial statements, okay? But I am an insurance company. I have insured very many people, okay? It is assumed that as on that last day of the year, there are people who I have insured and they have lost maybe their items or if their cars they've gotten accidents, if there are people they are sick, they're in hospital and I've covered them as Jubilee Insurance. So I actually have expenses or I have losses that I'm not aware about. In insurance, we call it incurred but not reported, or IBNR provisions. So something like that. In insurance accounting, you have to come up with a mechanism to make sure that you are actually able to make this provision. We have things like an earned premium reserves. If somebody has paid for his policy over the next 5 years, I have to make sure that I take a component of that premium that is for the future. That is more like prepayment accounting. So some of those estimations come specifically and they relate to the insurance sector. And we will look at some of those items in our topic for week 10. Accounting for corporations, this is obvious one. Then accounting for not-profit organizations. Yes, we know that in the economy and Uganda in particular, we have not-for-profit organizations, those that are not driven by profit, but they are after maybe making sure that they achieve their goals and objectives, of which the objectives do not include profitability, or the ones we normally call NGOs, for if I'm to just break it down for us. How do we actually treat them? You're going to find that some of the components of the financial statements of an NGO might be slightly different from these other trading entities, whereby on the other side we have a profit or loss statement or an income statement. If it is a typical NGO, we might call it statement of income and expenditure. This side we might call it a balance sheet or statement of financial position, but under the not-for-profit entities, we might call it fund accountability statement. And some of these terms actually come from the analogy and the objective behind what these entities actually do. If you go to USAID and they give you a grant of 2 million, they are going to say, okay, this is the grant we've given you, go spend on A, B, C, and D. And at the end of the year, give us a what? A fund accountability statement, which is going to be showing that you have given me this, I have spent this. So that's income and expenditure statement. And then this is the balance, and this is where the balance is seated. It's either in the bank or we have invested it somewhere. So you find that because of how these entities are running, then their statements can have different headings, even though it communicates the same message as the other statements we are used to for corporations, but the presentation and the terminology used is going to be a little bit more specific to not-for-profit organizations. Then we have segment reporting. Segment reporting is in business, you can have segments. You can have a company, but then you have like a standalone unit that is significant to the company's performance. And it is always very good to have it looked at and analyzed and understood separately. That is how segment reporting comes about. So we'll look at the specific considerations under segment reporting, and also what things do we actually do? What do we consider to say that this is a reportable segment and this is not a reportable segment? Then we will conclude by looking at translation of foreign currency statements. We acknowledge the fact that with the globalization that is happening, we have companies operating in different jurisdictions. You're going to have a company in Uganda, but it is born from the UK, or maybe the parent company is in the UK. And when they are preparing their financial statements at the end of the year, they might have to translate them and put them in dollars so that the information is comparable with maybe the head office numbers. How are you going to translate those financial statements into the currency that you actually want. Even in Uganda, we have companies that have subsidiaries and branches in other countries. And at the end of the day, when you're going to report, then you have to translate the other numbers in the other branches or subsidiaries currency of operation, and you put them in Ugandan shillings so that the consolidated report at the end of the year or at the end of the period can actually be understood by the people who are looking at the numbers, since they can only be comparable if they are in the same currency. And of course, there are rules and instructions, and there's a full standard IS 21 or International Accounting Standard 21 that talks about how we go about this translation. It's a very simple and friendly standard, and basically says that if you're translating the income statement, use the spot rate, because the income statement deals with transactions. So make sure that each transaction in the income statement, if they are sales, if they are expenses, they are translated at the rate when the transaction actually happens. If you go into the detail of the standard, it's going to say you can actually choose to take a year's average if the rate has not varied significantly over that period. Then for items in the balance sheet, those that are financial assets and liabilities, like creditors, receivables, cash and bank, borrowings, and loans, you can translate them using the closing rate. And then for non-monetary assets, like inventory and property, plant and equipment, or the fixed assets, you translate them using the spot rate or the rate at which the assets were acquired. So that those are the major items that we are supposed to be covering during our study and our coverage of this module. So what does it mean for us? We will have the Wednesday class, which is going to be on Zoom, and then that is going to be running from 8 to 9, strictly 1 hour. Because I know some of you may still be at work. Even myself, I want to, catch a few things after that before I get to sleep. And then on Sunday at 8 a.m., we will have the physical contact class, which is going to be at school. And we will always do about 2 hours. That's from 8 to 10. So make sure that you make arrangements and keep those hours open so that we can be able to do it, to cover whatever we have to cover. In the Wednesday class, we will always try to make sure that we do a bit of theory, and then when we meet on Sunday, then we do the illustrations and we get all kinds of clarifications that you might need during the live session where we are interacting physically. We can do the demonstrations on the board and all that. Okay. So strictly, let's get ourselves comfortable.
Yes,
Okay.
understood.
Okay, great, thanks. So let's get ourselves comfortable with partnership accounting. We will take a quick look at a bit of an illustration, and we can call it an evening. So basically for partnerships, we also have the profit and loss account and then the balance sheet. The only thing is that we will have an additional feature in these items, because these are partners who have to share their profits at the end of the year because they are individuals. Okay, they are individuals. It's not like a company whereby it's ABC Limited and it's the company. Here you know that it is Victor, Sarah, and Jessica, and we are partners. Though we have one profit or loss account, but you know that these are individuals who have just put their numbers together. So in their profit or loss account, we are going to have an extension or what we call the appropriation section. They have traded, they've made a profit. How is the profit shared? That is going to have to come out in the appropriation account of their income statement. So the income statement is going to really be the same: revenue, cost of sales, operating expenses, but we will have an extension for the partners appropriation account. And then the profits that have been shared in the appropriation account will also have to be taken to the partner's current accounts. If I've made a profit from the business operation, it will definitely increase my current account. The current account represents the stake or the amount of money that the partner actually has in this business. And when you're setting up a partnership, I think you guys must have looked at this somewhere in your business law. You must have heard about something like profit sharing ratios. So when the partners are in a partnership, the profit sharing ratios are going to basically be driving everything. Every profit they make during the year, it is going to be shared according to the existing profit sharing ratios. If you make a loss, you still go ahead and share it, and definitely that is going to reduce your current account. If a business makes loss, it means the money that you have in that business has reduced. So if we just take just a quick look at this illustration, we're saying that A, B, and C enter into a partnership and they've contributed share capital as 250 for A, 130 for B, and 120 for C respectively. And their profit sharing ratios is 5 to 3 to 2. B and C are entitled to salary of 16,000 and 14,500 per annum respectively. So you can see that from this arrangement, we have seen their capital contributions, we have seen their profit sharing ratios, and then we have seen that B and C are entitled to salaries, meaning A does not have a salary. Then there is interest on capital at 5% per annum. Interest on capital, if it is 5% per annum, it is going to be 5% of every person's capital. That is how much they are charging the partnership for the capital that they have put in. And then the drawings at 10% per annum. If there's a drawing, it's income. So the interest that we earn is always a credit to the partnership. Then profit for the year was 71,500 before they make any what? Before they make any adjustments. So they want you to prepare the capital and current accounts for the three partners, and you also prepare the fluctuating capital account. Sorry, I'm remaining with 10 minutes. Once this just goes off, you just join using the same link. In case my meeting just closes and locks you out, just join using the same link that you have that I shared with you. It will be active. I'll just restart the
Okay.
the link. Great. So we have seen that in this partnership we made a profit of 71,500. So this is what we are going to start with, or this is what we are going to start sharing. So and they are saying that in the question they said that this 71,500 was made before any adjustments. So this is the profit that we have. Okay, and they are telling us that do we have any incomes from these adjustments of the partners? There are some incomes. I said interest on drawing is an income to the partnership. Drawings is when you take money out of the business. So when you take money out of this partnership, these guys are going to charge you what? Interest. And this interest is going to be an income to the what? To the partnership business. But they are saying that these drawings are being taken on 1st of July, if you can see here. So if the drawings are being taken on 1st of July, it means we are only taking the drawings half a year, and the interest on drawings is 10% per annum. So that is why we take 10% times 6 out of 12 is 6 months. That is from 1st of July, 31st of December of 1999. So 6 out of 12 times 10%, which is the annual rate, then times. For the first partner, it was 40,000. For the second partner, 25,000. For the third partner, 15,000. So that is the interest we are getting. And it is totaling up to 2,000 plus 1,250 plus 750, it's totaling up to 4,000. So 4,000 plus 71,500, what do we get? 71,500 plus 4,000, it gives us 75,500. Now, interest on capital is an expense to the partnership. Same format, interest on capital was 5%, and A brought in capital of 250, B brought in capital of 130, and C brought in capital of 120. So the total interest on capital, which is an expense to the partnership, is 25,000. Then we have salaries to partners. We said that B and C were entitled salaries of 16,000 and 14,500 respectively. That is why we are having salaries of 30,000. So 30,000 plus 25, that's 55,500. When we subtract it from our 75,500, we remain with 20,000. And don't forget about our profit sharing ratios. Our profit sharing ratios were 5 to 3 to 2. I hope you all remember your ratios from your business statistics. So 5 plus 3 plus 2, that is 10. So the first person will take 5 out of 10. The second person will take 3 out of 10. The third person will take 2 out of 10. And that is how they are going to share the 20. One will take 10, the other one will take 6, the other one will take 4. And the 10 is what? The 10 is done. Sawa. So the appropriation account is basically done. Appropriation, we get the profit from operation. If there are any transactions with partners like salaries, drawings, interest on capital, we incorporate them in. Then whatever we remain with is what we actually share amongst the partners in their respective sharing ratios, which we have done. Then when you got the capital accounts, the capital accounts, there has not been any change in capital, if you will notice, because in the question they are telling us that they entered into a partnership. We don't know when, but it is some time back. And their capital is 250, 130, and 120. Okay. And you all know that from our financial accounting, capital accounts have a normal credit balance. Okay. That is why we are recording them on the what? On the credit side of the what? Of the capital accounts. And we just balance them off because there was no change in the what? In the capital. We can have instances where they tell us that this person brought in additional money. In such a case, then we are going to have someone's account increasing. If, for example, they said that partner A brought in an additional 50, then we would debit our bank and we credit his capital account, and we find that his capital account is standing at 300,000, but there was not really any mention that there was a change in capital of any of the partners. Then the current accounts, in principle, they give us the transactions between the partnership and the partners. They give us the transactions between the partners and the business. So the very first one was the interest on capital. If you charge interest on capital, then your current account is going to be credited, because ideally you have given money to the partnership. Okay, so if you charge them interest, then your current account is going to do what? It's going to grow. So we have interest on capital increasing the current account. Okay, so the first partner, who is A, his interest on capital was 12,500. Then for B, it was 6,500, and then for C, it was 6,000. Okay, that is the total. That is the interest on capital that partner A, B, and C are getting. And these same partners were earning a salary from the what? From the partnership. And we saw that B was earning 16,000 and C was earning 14,500. If we just take a look back, this is right here. Okay. Remember these ones? B was 16,500, 14,500. And then the current account is where we record what we got from the business. When we ran the business, how much was the profit that we shared? You see here at the end here, the profit shared, A got 10,000, B got 6,000, and C got 4,000. So this is the profits that is shared. I think the person who put the material on the system forgot to, okay, no, it's just down here, share of profit. You can see down here, the laboring share of profit, 10,000, 6,000, and 4,000. These are the things that you get from the partnership. Remember, we are looking at it from a capital account and a current account. They are almost the same, just that they record items of different kinds. So the current accounts, or the fluctuating capital account, are going to do what? To record on the credit side whatever you get from the partnership, and on the debit side they are going to report, so the current accounts first, we are going to record whatever transactions you carry out with the partnership, including your profits that you have shared. And then on the other side, we have those things that you spend on with the partnership, like interest on drawings and the drawings themselves. Because when you draw money from the business, then you have